Hi, everybody. It's Peter Schiff. It is Saturday, June 1st, 2013. We got a lot of economic data that came out this week, most of it confirming my point of view that the recovery is merely an illusion created by the Federal Reserve. We got revisions to the first quarter GDP. Originally, they reported 2.5% growth. They revised that down to 2.38%. Of course, the only reason I believe it's even a positive number is because the inflation measures are too low. So we are not deflating nominal GDP sufficiently to show an economic contraction, which I believe is still ongoing. But if you look beneath the surface of the official numbers, you'll see some more disturbing trends. Number one, the savings rate plunged all the way down to 2.3%. That's the lowest household savings rate since the third quarter of 2007. And of course, back then, Americans still thought they were rich because they had all sorts of home equity and they were spending like crazy. I don't think that's what's going on now. I think the reason that Americans are depleting their savings is because they need the money for food. They need the money for gasoline. They're trying to keep their economic necks above water. That's why they're having to deplete their savings. If this was really a recovery, Americans would be flush. They would be earning more, and therefore they would be saving more. They would have a bigger cushion. That's a reflection of a repaired balance sheet. If times are good, you have more savings. You're not depleting your savings. That's a sign of household distress. Also, maybe even more disturbing, we had a plunge in discretionary income. Real discretionary income dropped by 9.03% at an annualized rate during the quarter. That's the biggest drop, I think, in memory. It's bigger than any drop that we had during the official days of the recession in 08 or 09. So how is it that household incomes are falling faster during the recovery than they did during the recession? The only thing that makes sense to me is that we don't have a recovery. We're still in recession. Yet despite this, despite plunging incomes and depleted savings, we found out that consumer confidence was at a 5-year high, and we just had the biggest year-over-year increase in real estate prices. I think it was 10.9% since 2006. So consumers are confident, not because they're earning more or because they have more savings in the bank, but because their house is more valuable, or because they think their house is more valuable. Also, I think all of the constant media hype about this recovery, I think has created a false sense of optimism among the public that a recovery is actually coming. Now, maybe they haven't experienced it, but they're just waiting for the beneficial results. After all, everybody says there's a recovery, so consumers are optimistic that they're going to see it. Even though they haven't experienced it yet, they've been led to believe falsely that recovery is right around the corner. But clearly, an increase in the stock market, an increase in real estate prices creates the illusion of recovery. It creates a wealth effect. And more importantly, it enables Americans to borrow. Homeowners in particular, one of the reasons they've been able to sustain consumption is because they've used inflated asset values to borrow and then spend more money. They've refied, they've got record low rates, but a consumption boom that is financed by debt related to inflated asset values, that is exactly how we created the financial crisis of 2008. Traveling down this exact same road again is not going to lead to a different destination. In fact, I think it's an even more perilous path that we're following now, and I think the results are going to be even more horrific. Later in the week, we got, in fact, I think it was Friday, we got the April household income and spending data. And again, incomes were flat. So we had no recovery from the first quarter in the second quarter, and spending actually notched down 0.2%. So the data continues to support the idea that the much touted recovery is really limited to rising asset values that are completely dependent on the Fed continuing to QE, but meanwhile, they're talking about tapering. They're talking about taking away the punch bowl, or at least gradually removing it, maybe putting a little bit less alcohol in it than normal. But still, the market, I think, is oblivious to that reality. Now, maybe there was a bit of a wake-up call on Friday. The stock market was up a little bit. I mean, not a lot, but it had gained a little bit on the week until Friday. The Dow lost better than 200 points on Friday, which put it negative of about 1.2% on the week. But all of the losses happened on Friday. In fact, 70 points out of that 200 was lost in the final 5 minutes of trading alone. Now, one of the catalysts was rising interest rates and falling bond prices. Bond prices actually fell more on the week than stock prices. I think bond prices were down about 1.7%. And I've been saying all along that the biggest risk is not the stock market, but the bond market. And bond investors got clobbered this week. The yield on the 10-year went from 2.01% last Friday. It closed at 2.164% this Friday. That's a big move. Intraday, we got above 2.2, and we surrendered. The bond market had a bit of a rally during that last hour as the stock market was selling off. Now, the dollar was also lower on the week by about 0.4% if you measure it by the dollar index. But the dollar paired some of its losses on Friday after the release of a better than expected Chicago Purchasing Managers Index. The market seems to be grasping for straws, looking for any confirmation that the recovery is actually here. But I think you have, an island of good data in a sea of bad data. The market should be looking at the good data as an anomaly. The real data is showing a weakening economy. My expectation is a week from Friday when we get, or last Friday when we get the non-farms payroll numbers, the markets again will be disappointed by weaker than expected job growth. Now, gold prices were relatively flat on the week. I mean, pretty much flat, but gold stocks soared by 7.5%. If you measure it by the Gold Bugs Index, the HUI, H-U-I, it was up 7.5% on the week. That's the biggest weekly gain for gold stocks, I think, since January of 2012. So in more than a year. And I think what was interesting is that even though gold was down 20 bucks on Friday, surrendering, its gains on the week, gold stocks were barely down, and they had a very impressive rally in the last 15 minutes of trading. Maybe this is further evidence that the bottom I spoke about during my last video blog is in. It seems like we've exhausted the supply of sellers. Even with gold down 20 bucks and $1 higher, there weren't a lot of sellers around for these gold stocks, and buying came in. So we'll see how that momentum might move into next week. But again, we had that very strong reversal day in the gold market that I pointed out, and the action we're getting now in the gold stocks is more additional confirmation that the low that I talked about may in fact be in. And also, we're getting more data that the high in the bond market may be in. And it makes sense that those two would be working in opposite directions. But I think the most important news of the week came out late Friday. In fact, I didn't even notice it myself until this morning. That's how late it came out. But the Federal Reserve posted on its website the minutes of the most recent meetings of the Federal Advisory Council. And they meet, I think, 4 times a year. It's a collection of 12 bankers, and they work with and help advise the Fed on monetary policy. And it's unbelievable what was actually said in these minutes. And I'm gonna read you some of the highlights or the lowlights. I've condensed it down so I don't have to spend too much time reading. But I think they tried their best to sugarcoat the message that they were sending. But when you read between the lines, and it doesn't take much to do that, basically what it boils down to is they're admitting that the Fed's monetary policy has not been effective. It hasn't produced legitimate economic growth. All it's done is inflate asset bubbles that have made us feel good, that have made us borrow too much money and spend too much money, but the Fed has completely distorted the market, and that when the QE stops, it's going to be a complete disaster. That's basically what they said. They said, hey, when the party's going to end and it ain't going to be fun, there's going to be hell to pay for what the Fed has done. That's basically what they said. But let me read to you what they did say, and you can draw your own conclusions. So and again, I'm not reading every word. I'm just taking the important parts out of. You can get out of what they said. You can see the entire minutes. They're up. They're up on the internet. I originally even found out about it up on the Zero Hedge website. But let me start reading. Okay, this is from the minutes of the meeting that took place on May 17th. But they were just put up on the Fed's website on Friday. Here's what they said. Quote. This is all quotes. The aggressive rate of asset purchases has helped maintain low short-term and mortgage interest rates and liquidity in the markets, obviously. This, in turn, has increased prices of debt and equity securities, consumer confidence in spending, and confidence in the financial markets. So, in other words, they're admitting that the Fed policy has inflated asset prices and that those higher asset prices has instilled confidence in the markets and in consumers. Now, they go on to say this, quote, however, the effectiveness of the policies in producing healthy economic and employment growth is not clear. Economic growth has remained sluggish and uneven. While some believe monetary policy may not be accommodative enough, others believe that consistent injections of new reserves have not returned the economy to the vibrant, upbeat model it used to be, and that current monetary policy is ineffective. This is coming from the official Federal Advisory Council. These are bankers. These are not gloom and doomers like Peter Schiff. These are mainstream guys who are finally acknowledging what I've been saying for years. Now, let me continue. Quote, this is some good stuff here. There are potential risks associated with current policy. Boy, that's an understatement. Now I'm going to get back to the quote. Quote, the Fed's securities purchases have reduced mortgage yields and, to a lesser extent, treasury yields. Current low bond yields are disruptive. They may encourage unsophisticated investors to take on undue risks to achieve better returns. You think? I mean, come on, that's what's going on. Now here's more of this. Quote, MBS purchases account for over 70% of gross issuance, causing price distortions and volatility in the MBS market. That's mortgage-backed securities. Many are concerned about the Fed's significant presence in the market. There is also concern about the possibility of a breakout of inflation. Well, duh. But, they're actually admitting it. People are concerned about inflation. What do you know? Now, here's some more of this. Quote, further, current policy has created systemic financial risks and potential structural problems for banks. Systemic risks, structural problems? Yes, that's exactly what I've been saying. Everybody in the mainstream has been ignoring that reality. Now, finally, somebody has the guts to say it in a position, I guess, of some credibility. Here's more. Net interest margins are very compressed, encouraging banks to take on more risk. Here, the bankers themselves are admitting that the low interest rate policy of the Fed is encouraging the banks to take on more risks than they otherwise would take in a free market without this interference. Now, it actually gets better. Listen to this. All right. Remember, this is all word for word quote. I'm not paraphrasing anything. This is exactly what was said. I'm just leaving some stuff out for the sake of brevity. Okay, here, quote. The Fed's aggressive purchases of 15-year and 30-year MBSs have depressed yields. Banks seeking additional yield have to run to investment options with longer durations, lower liquidity, and or higher credit risk. Finally, the regressive nature of the artificially compressed savings yields creates pent-up demand within bank deposit portfolios. These deposits may be at risk once yields begin to rise and competitive pressures increase. There they said it. Our bank deposits will be at risk when interest rates rise. What do you know about that? What about the FDIC? The deposits are at risk, just like the deposits were in Cyprus. Let me continue here. This is probably the best of it all. This is where they bring it home. Uncertainty exists about how markets will reestablish normal valuations when the Fed withdraws from the market. Now, that's an admission that valuations are inflated because of the Fed. And they're worried about how valuations will return to normal, meaning prices go down when the Fed removes their supports. Let me continue this quote. It will likely be difficult to unwind policy accommodation. Wait a minute. I thought it was supposed to be a piece of cake, right? The Fed said they had the tools. Here, their own advisors are saying it's going to be difficult. And again, that is a massive understatement. It's not going to be difficult. It's going to be impossible. And the end of monetary easing may be painful for consumers and businesses. Let me repeat that. The end of monetary easing may be painful for consumers and businesses. It won't just be painful, it will be excruciating. And not just consumers and businesses, they left out the government and taxpayers. I guess taxpayers and consumers, maybe they're the same thing, although not necessarily, because there are a lot of consumers who don't pay taxes. But I thought that we're having a recovery when the Fed removes the accommodation. But if the removal of the accommodation will be painful, doesn't that mean that we're back in recession? Because if the economy were still growing, that wouldn't be painful. The pain only comes as we relapse into recession. So to me, this is an admission that the phony recovery will end when the stimulus ends, and we'll be right back in the pain of a recession. Here's the final sentence. Given the Fed's balance sheet increase of approximately $2.5 trillion since 2008, the Fed may now be perceived as integral to the housing financial system, to the housing finance system. It's more than just integral. The Fed is the housing finance system. The government guarantees all the mortgages, and the Fed buys them. See, this is worse than what happened during the housing bubble that burst in 2008. Yes, you had government guaranteeing the mortgages, but they were still owned privately. Now, not only does the government guarantee even more of the mortgages than they did then, but the government actually owns all of the mortgages. Now, I think this is some very startling information to come from a mainstream source. Now, I mean, none of it surprises me. I mean, I've been saying this for years, and the mainstream has ignored my voice and voices similar because they say we're kooks, we're nuts, we're stop clocks, stuff like that. But how are they going to say that about this committee, the Federal Reserve Advisory Committee? These are mainstream bankers finally coming to the same conclusion. Now, I don't think they're as dire in their warnings because I think they're deliberately sugarcoating this. But the fact that they're pointing this out, to me, shows that they know how screwed up the situation is, the box that the Fed is really in, and how badly this is going to end. Now, I'm not sure exactly when this got up on the Fed website and whether it was partially responsible for that sharp sell-off going into the close. We'll find out because the information is now out there. It's being reported. We'll see how the Asian markets react to it on Sunday night. I mean, maybe this could be the equivalent of the irrational exuberance comments of Alan Greenspan back in, 1996, 97 or something. Now, of course, the market sold off originally. There was a one-day sell-off, and then, of course, the markets ignored the chairman and went up anyway. I think that what these minutes reveal is far more startling and potentially disruptive than the comments that Alan Greenspan made about irrational exuberance, because I think this shows that the exuberance is far more irrational now than it ever was back then. So we'll see Sunday night if there's any reaction to this in the currency markets, in the precious metals markets, in the stock markets. But I think that it has the potential to be a big wake-up call. Maybe it could be a emperor has no clothes type moment. That's all for now. Don't forget to tune in to my daily radio show, The Peter Schiff Show, if you want to get more frequent coverage of this ongoing situation. Remember, I do it every weekday from 10 a.m. to noon Eastern Time. That's Monday through Friday, 10 to noon. And you can listen at schiffradio.com if it's not on a radio station in your area. If you can't tune into the live broadcast, we repeat the 2-hour program continuously on a loop the entire day until the next live broadcast. And as always, keep checking in at the Schiff Report I will be updating my video blog with more information as it becomes available. That's all for now. Take care, everybody.